Hello and welcome to BQ Prime. You're watching Earnings with BQ, and our guest today is Dr. Gangadi Madhukar Reddy, founder and CEO of MedPlus Health Services. Welcome to the show, sir.
Thanks.
So you had a wonderful quarter with the revenues up 30%, net profit has jumped 1.2 times, operating profit is up 56%, and margins have come in strong despite a store addition of 284 crores at 6.5% over the last year. So if you could help us understand what has aided this margin growth.
Yeah, actually, over the last 1 year, as you said, we added a net of 1,074 stores. That's nearly a 33% addition on our overall network. So that basically pulled the margins a little down. But, it has been stabilizing now. We also had a good quarter. Typically the Q4 is generally a good quarter for pharmacy industry and all, pharma retail. I don't expect the same on Q1 though. But otherwise, the effect of the increased number of stores continues to go down because we are, maintaining almost at the same level of growth. So for us, going forward, we will also add another 1,000 stores, which means it'll only be a 25% addition on this. So which basically means the effect of the new stores is going to be slightly lesser. But yeah, all in all, I would say that it is doing more of the same, getting slightly better every day.
So if you could help us understand what sort of, by when do we do a break even on these newer stores, and what is the margin on the newer stores versus the older stores?
So typically our stores break even in anywhere between 3 to 6 months. Something like 60% of the stores break even in 3 and 75% of them break even in 6 months. And after that, they get to a 10% EBITDA at the store level within 2 years, 24 months. So if the entire network were to be, which is when they kind of mature. So the entire network were to be at 24 months, you would see a different kind of EBITDA. So for us, given that something like 50% of the network is under 2 years, there is a lag. But an answer to your question, every store which starts off, at least 50 to 60% of them break even in 3. And something like in a year's time, they all start at roughly around contributing around 3 to 4% of the EBITDA. At the end of 2 years, they do 10%. So that's the path.
So if I were to understand this correctly, can we expect that the EBITDA levels would inch up in the next 2-3 years from the current levels?
See, EBITDA growth is going to be a function of several things. It's not just going to be just the no drag of the new stores, but also the positive benefits of adding so many new stores. So what that will do is basically bring the scale benefit. Our warehousing cost, which is at 3% right now, we expect will continue to go down over a period of time. Our corporate costs, which are at 2%, will also continue to go down. As we add stores, we're not going to add that many people anyway. That's the scale benefits. And private label, which contributes a significant portion of our overall margin, will also contribute more as we go forward. Every 1% increase in private label pharma in the pharma products increases our overall margin by 0.4. So we'll also expect to see that. But these things will all play out over a period of time. I can't quantify them exactly, but over a period of 2 years, absolutely, they'll all have positive benefits.
So if you could help me understand a little bit more on the private label side of business, what exactly is it and how is the acceptance towards it? Because, for the longest time, the bigger pharma companies have been reigning the markets. But what is the kind of acceptability that people have now towards private labels?
So our private label, which currently stands at around 13 to 14%, has 8% of pharma and roughly around 5% of non-pharma. The non-pharma includes around 3.5% of hair care, skin care, and other FMCG products, and 1.5%, 2% of medical devices. Things like glucometers and BP meters and digital thermometers and all, and surgical items and all that sort of stuff. The critical thing though is pharma, which is where we make most of our margin. Now this one is at 8. I expect it will grow slightly, probably go up to 9 or 10% over a period of time, or 10 or 11. I don't really expect it will go much beyond that, mainly because there is only so much you can see. A lot of it is OTC drugs where people come in for pain, headache, cough, cold kind of medication. And given our size, we also are able to produce these products with high quality manufacturers and give them to customers. So customers are not super brand sensitive, and they're not driven by a prescription on the OTC products. So they go with our brand. But in addition to that, we also have a lot of other products which kind of fill in on the convenience angle, where a customer walks in with a prescription of 6 to 7 drugs. And if you don't have one or two of them, given that 95% of Indian market is branded generic, which means they're all brands, but they're all generic products in which no one really has any kind of, let us say, a patent or a copyright kind of situation. So which means several hundred people are making those. So we are always able, and given that there's so many different brands, it's always difficult to get every single thing right, every single thing stocked at the place. So if one or two products are not there, we would normally suggest the customer to actually accept something else. And a lot of times with, permission from their, let's say from the doctors, or based on their own decision, they end up actually taking one or two substitutes. And that is what basically drives the overall private label in the non-OTC segment.
Okay.
But there is only so much you can do. You can't basically say, I don't have all the 6 which you asked for, I'll give you some other 6. So you can never really grow beyond, let's say, 1 or half of the entire prescription which comes around on an average.
Okay. So the growth is expected to remain at around the same lines. I mean, just 1% or 2 more. That is.
Private label will probably grow maybe to 10% or something like that. On the other hand, the top line itself could grow much better. Last year we grew more than 20%. Roughly around 20. And this year, given that we have added a lot more stores, we should easily do a 25% growth easily, I think.
So one more question on so there have been recent media reports suggesting that the government will now not mandate the buying of the full strip, and people can approach the counter and request for the medication that they need, which is, I believe, very much the OTC drugs that people take. So if that were to be the case, do you believe that this would hit the pharmacy business at an overall level, as well as your private label business, because that also deals with a lot of these common medications?
Not really. Mainly because, as a company, we have always given a strip and less than a strip also. We recognize that, a lot of people won't require the full strip. And our practice is to give whatever the customer asks for.
Okay.
I don't think it'll really affect us much.
Okay. So also in terms of store growth, you said you're looking at adding another 1,000 new stores. So is it going to be in the existing markets, or are you planning to expand more towards the north? Any newer states that we're targeting?
Absolutely. So we're looking at adding 3 new states, and these are adjacent to the states in which we are already present. So we will be opening up stores in Raipur, Chhattisgarh state.
Okay.
Indore of Madhya Pradesh, and Cochin and Kerala. So all these 3 will come on board this year. Based on how they do and how well they ramp up, we will add more cities in those states.
Okay. Also, sir, how do we look at diagnostics from here on? Because diagnostics is usually a higher margin business than your existing business, and you're doing that. But for now, the EBITDA has been in the negative. So I believe it's still a pilot. So when do you see this turning profitable? Also, diagnostic space, as we all know, is quite competitive. So what are the kind of tests that you're planning to target? Is it the normal preventive check, preventive and wellness healthcare checkups, or are we going for more niche diagnostic segments? How is it going to be in the future?
So our diagnostics model is, I would say, fairly unique, and it is an integrated, play where we do both radiology as well as biochemistry, pathology, and microbiology and all.
Okay.
So it is not just one blood samples or urine samples. 2, it is both for wellness and for people who actually want to bring in a prescription and get themselves checked for whatever the doctor has written. 3, it is available online, offline, and through our stores. So the network is fairly well spread out. You could basically do online request for a phlebotomist to come to your home and take the sample. You could walk into any of our 100 collection centers in Hyderabad, which are embedded in our stores, or walk into some of our larger centers and get everything from a CT scan to MRI to the entire works. So we have a full, play on this whole thing. That's one. Second, it's also based on a subscription model. where a person comes in and pays 1,000 rupees. And for that 1,000 rupees, he actually gets a 75% discount on tests right through the year. Every single test which he actually does. We have we have actually exceeded now 100,000 members overall who have become members. And the unique part of the thing is that, yeah, you pay a small bit of money, it's a subscription model, and you get a 75% discount. So MRI, which should otherwise cost you around 8,500 rupees, costs around 2,000 rupees with our center. And for that reason, we have seen a huge uptake by the customers. And for that reason, we, as I said, we already have 100,000. The way we plan it, the subscription amount pays towards the capex and everything else. The variable cost is taken care of by the 25% which they pay. After the 75% discount, 25% is the cash out.
Yeah,
right? We look at it at something like an insurance, where you pay a small premium and you get all the services free, but there is a small copay. Copay is 25%.
True. But so how does this, I have a couple of questions here. So when you say you're paying 25%, so does it include all wellness checkups as well? Because people go in for wellness checkups far more regularly than they'd go for a prescribed one, right?
So we don't mind if you come in for a checkup every single day. There is no restriction. So it could be a wellness checkup, it could be a prescribed checkup, it could be anything. If you want to get an MRI done every day, you could get it done.
Then so how does the economics of this work?
Because so the way it works for us, the way it works for us is, it is a subscriber-led customer walking in. So there is no referral fee to another lab or to a doctor. True. That saves us a 30%.
Okay.
Typically, labs make around 30-35% EBITDA.
Okay.
We make our money through the subscription amount. So we don't make money here. And 3, because of the price and the scale, the utilization of the machines and the people and the place is so high that even at the 25%, we actually break even and make money.
Okay.
So it is not a hardship for us if you come in every day and get the test done.
Okay.
We're just bringing the benefit of, let us say, a bunch of guys in a city buying up the machines. You could say that, you are part ownership of the machine almost. And so you don't have to worry about the machine cost. You're only worried about the variable cost. And as long as you're paying the cost of that variable cost out there, you're paying the full cost. It doesn't matter to us how many times you come and do the test.
Okay. Then, so when are we expecting this business to turn profitable? And from what I understand right now, it's only in Hyderabad, right? So
it's a brand new business with a completely disruptive model. We expect that we'll actually do very well. Customer uptake has been fantastic. People love it because of the discount. The fact that 100,000 people have paid that money to become members and start using the thing out there is testament to it.
Yeah.
This is all B2C though. This is all people who are walking into our stores and becoming members in our stores or walking into the centers. We are still looking at the B2B. We're in conversations with major insurance companies and all to figure out how this can become part of the insurance. Where, typically, if your employer basically gives you health insurance, he would have been paying 20,000 rupees odd for a family of 2+2 to give you a health cover, health insurance. But that insurance kicks in only if you're hospitalized for more than 24 hours. So for anything which is outside the hospital, you're on your own. What we're trying to do is basically get the insurance companies to charge 1,000 rupees more, pay us that money, and offer you the discount, offer you the insurance on labs. So which should obviously, for a small extra money, it's just 5% over the premium, you'd actually end up getting a full coverage, not just for your hospitalized, needs, but also the out of hospital needs.
Okay. That is extremely interesting, sir. Also, are we looking at expanding it through India? I mean, for now, it's just a pilot, right? So
no, absolutely. We will expand it. The whole object of the pilot is to prove it beyond a doubt and all, raise additional money and go across the country. So as we said, we want to do it as an insurance. So basically it means that, the benefits have to be, available to anyone who basically buys it across the country. So eventually, we'll go city by city, of course, but not right now.
Okay. And for now, what are the sort of margins that we see on the diagnostics business? What we can expect to see?
Very difficult. I can't put that. I'll tell you why.
Okay.
We're only
Yeah.
looking at recovering the variable cost and everything else right now.
True.
The money is
Yeah.
going to be made by membership. So today we have 100,000 members, but tomorrow, let's say we have 500,000 members. That's 50 crores, right?
Yeah.
And that all goes into profit. So it is going to be a function of the number of members. So it's still out there. Yeah.
Yeah, it'll be interesting to see how that plays out with the overall margins, because I believe this has quite a capacity to scale up.
It could, become as good as pharmacy, or it could become much, much better, depending on how it goes. Hence, we're doing the pilot. So if we are happy, if the ROCEs are better than what we do in the pharmacy, then obviously we'll invest and go across the country. But it has a potential of being like a hockey stick kind of thing, where once the initial, word of mouth kicks in and people start coming in, and once one or two companies basically become members, it'll be difficult for other companies to say no to the membership.
Yeah.
It's not a big cost, right? It's only 1,000 rupees per year per employee. And it is part of the overall health illusion. So I expect once it takes off, it'll take off big time. But, till then.
So do you believe that other diagnostic players may also adopt the same kind of model that you've come up with? While it's disruptive, it's not difficult to also emulate it.
Yeah, so, given that I'm explaining it in such great detail, it's not really difficult. Everyone knows about it. No, I don't believe it's that easy. We're doing it on the back of the 4,000 store network which we have. We have over 4 lakh customers who walk into our stores every day. And these guys, most of them actually buy medicines for chronic needs. And these are good customers who basically need the testing, hence become members. The cost of acquisition will be far, far higher for anyone else to attempt it. But they could always do it. Yeah, they could always.
So even with competitive pricing, you believe you have the edge here?
No, I don't think there's any price in the market which beats our price today at 75% discount.
Yeah, true. Perfect, sir. This is a great conversation. All the best. It's a pleasure having you. Thank you so much.
Yeah, thank you for inviting me. Thanks.